Preparing for FP&A Analyst at Xcel Energy interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does FP&A contribute to a utility like Xcel Energy? FP&A helps Xcel Energy connect operational activity with financial outcomes. I would support budgets, forecasts, variance analysis, capital planning, and management reporting while understanding drivers such as customer demand, weather, fuel costs, rates, and operating expenses. In a regulated utility, accuracy and transparency matter because investment decisions affect reliability, affordability, and future rate recovery. My role would be to challenge assumptions constructively, explain results clearly, and help leaders make informed decisions. While answering, focus on budgeting, forecasting, performance analysis, decision support, regulated utility economics, capital planning, and translating operational drivers into financial insights for leadership. Question 2. How would you build an annual budget for Xcel Energy? I would begin with corporate targets and strategic priorities, then build a bottom-up plan with operating and business unit leaders. Revenue would reflect customer counts, usage, approved rates, and weather assumptions, while expenses would incorporate labor, maintenance, fuel, purchased power, and inflation. I would separately model capital expenditures and financing needs. After consolidating submissions, I would challenge unusual assumptions, run sensitivity cases, reconcile to strategic targets, and establish a monthly process for tracking budget performance. Make sure to cover top-down guidance, bottom-up operating plans, revenue and expense drivers, capital expenditures, workforce assumptions, regulatory requirements, review cycles, and documented version control. Question 3. How do you distinguish a budget from a forecast? A budget is the approved financial plan and performance baseline for a defined period. A forecast is the latest estimate of where results are heading, incorporating actual performance and updated assumptions. I would use the budget to measure accountability and the forecast to support decisions as conditions change. For example, if storm restoration costs rise unexpectedly, I would preserve the original budget for variance reporting while updating the forecast and explaining the operational and cash implications. In your answer, explain the budget as an approved baseline, the forecast as an updated outlook, their different purposes, timing, ownership, and how variances are interpreted against both. Question 4. Walk me through how you would perform a monthly variance analysis. I would start by validating that actuals are complete, correctly classified, and comparable with the budget. Then I would quantify material variances, separate price, volume, timing, mix, and one-time effects, and investigate unexpected movements with the responsible business owners. I would distinguish accounting timing from genuine performance changes, update the forecast where necessary, and summarize causes, outlook, and actions for management. The objective is not merely explaining history, but improving future decisions. Be sure to mention actual to budget and actual to forecast comparisons, materiality, favorable versus unfavorable effects, root cause analysis, business owner discussions, corrective actions, and concise management reporting. Question 5. What financial and operational drivers would you monitor at Xcel Energy? I would monitor customer connections, usage by customer class, weather-normalized demand, approved rates, fuel and purchased power costs, transmission activity, labor, maintenance, storm costs, and capital project progress. I would also track reliability metrics, renewable additions, emissions trends, and regulatory milestones because they influence both spending and future recovery. At Xcel, financial results cannot be understood independently from system operations, customer behavior, and the regulatory environment. I would connect these indicators through a driver-based forecast. Focus on customer growth, energy demand, weather, rates, fuel and purchased power, reliability, headcount, maintenance, capital spending, renewable investment, and regulatory developments. Question 6. How would you forecast electricity revenue? I would forecast revenue by customer class using customer counts, expected usage, approved tariff rates, seasonal patterns, and known riders or adjustments. I would analyze historical billing data and normalize for unusual weather before applying current rate assumptions. I would also separate volume, price, and mix effects so management understands the movement. Because weather and regulatory timing can create uncertainty, I would prepare base, downside, and upside cases and reconcile the forecast to recent actual trends. Discuss customer counts, usage by segment, weather normalization, rate schedules, seasonal patterns, riders, regulatory decisions, billing data, and scenario analysis for uncertainty. Question 7. How does weather affect a utility's financial performance, and how would you model it? Weather affects electricity and natural gas usage, especially through heating and cooling demand. I would compare actual heating and cooling degree days with normal levels, estimate customer class sensitivity, and quantify the resulting volume variance. The model should reflect regional and seasonal differences rather than applying one blanket assumption. I would then separate weather-driven results from structural changes such as efficiency, customer growth, or load shifts, helping leadership understand whether performance is temporary or sustainable. Mention heating and cooling degree days, customer class sensitivity, historical normalization, seasonality, regional differences, scenario ranges, and distinguishing weather effects from underlying demand trends. Question 8. How would you forecast fuel and purchased power expense? I would combine expected load with the generation fleet's projected dispatch, plant availability, fuel efficiency, contract terms, and forward commodity prices. I would separately model owned generation, purchased power, transmission charges, and hedging impacts. Key sensitivities would include natural gas and coal prices, renewable output, weather, outages, and market pricing. I would reconcile actual cost per megawatt-hour to plan, investigate mix or price effects, and communicate what portion is recoverable through regulatory mechanisms. In your answer, cover generation mix, commodity prices, load, plant availability, hedging, market purchases, transmission costs, contract terms, and sensitivity analysis. Question 9. What is rate base, and why is it important to FP&A at Xcel Energy? Rate base is generally the value of eligible utility assets used to provide service, adjusted for items such as accumulated depreciation and approved regulatory treatment. Regulators typically allow recovery of prudent investment plus an authorized return. For FP&A, rate base growth links capital spending, depreciation, financing, earnings, and future revenue requirements. I would therefore forecast project timing carefully, distinguish construction from placed in service dates, and consider regulatory lag and customer bill impacts when evaluating investment plans. Explain rate base as eligible utility investment, its relationship to allowed returns and depreciation, capital planning, regulatory lag, customer affordability, and earnings forecasting. Question 10. How would you analyze a large capital project investment? I would first clarify the project's purpose, such as reliability, compliance, generation transition, or customer growth. Then I would assess scope, timing, total installed cost, operating impacts, avoided costs, regulatory recovery, and execution risks. I would compare the project with alternatives using discounted cash flow, scenario analysis, and operational benefits, while monitoring committed versus spent capital. At Xcel, I would also consider rate impact, stakeholder requirements, and whether delays could affect both earnings and service reliability. Cover business need, reliability and compliance benefits, capital phasing, schedule, total cost, operating savings, regulatory recovery, risks, cash flow, and return or value metrics. Question 11. How do you evaluate whether a capital project is on track? I would compare actual and committed costs with the approved phasing and measured physical progress, not simply review invoices. I would update the estimate at completion, assess schedule milestones, review change orders, and test whether contingency remains adequate. I would meet project managers to understand the operational cause of deviations and distinguish timing from genuine overruns. My report would show budget, actuals, commitments, remaining forecast, completion date, key risks, and the expected effect on cash flow and rate-based timing. Be sure to mention earned progress, actual versus committed spending, forecast at completion, schedule milestones, change orders, contingencies, risks, and communication with project managers. Question 12. Tell me about a time you improved a forecasting or reporting process. In a previous role, our monthly forecast relied on multiple spreadsheets with inconsistent assumptions and frequent manual rework. I mapped the process, standardized driver definitions, created a controlled input template, and built automated validation checks. I partnered with accounting and operating managers to test the design and documented ownership and deadlines. The cycle became faster, errors declined, and review discussions focused on business drivers rather than reconciliation issues. I would bring the same disciplined, collaborative approach to Xcel. Use a concise STAR example covering the original inefficiency, your analysis, stakeholder collaboration, automation or standardization, measurable improvement, and control or sustainability. Question 13. What would you do if a business partner challenged your unfavorable variance analysis? I would first listen carefully and determine whether we are using different data, timing conventions, or operational assumptions. I would trace the variance to source transactions, compare it with the business partner's explanation, and revise the analysis if the evidence supports it. If the variance remains valid, I would explain the calculation clearly and discuss corrective actions rather than assigning blame. The goal is a trusted answer that reflects the business reality and improves the next forecast. Focus on listening, validating data, separating facts from assumptions, reconciling definitions, using source evidence, maintaining professional challenge, and agreeing on actions or escalation. Question 14. How would you explain a complex financial result to a non-finance executive? I would lead with the conclusion and quantify the impact before explaining the mechanics. For example, I might say earnings are below plan by $12 million, primarily because warmer weather reduced residential demand and a maintenance outage increased costs. I would separate temporary effects from structural issues, explain the forecast implication, and recommend an action. I would use a simple bridge or chart and keep technical accounting detail available as backup rather than making it the headline. Mention leading with the conclusion, using plain language, quantifying impact, separating drivers, highlighting risks and actions, tailoring detail, and avoiding unnecessary accounting terminology. Question 15. Which Xcel tools would you use most in an FP&A role? I use Xcel for structured analysis rather than disconnected calculations. Common tools include SumIfs, Xcel OOKUP, index match, pivot tables, logical formulas, data validation, and sensitivity tables. For recurring reporting, I would use Power Query where appropriate to standardize and refresh source data. I also build checks for missing inputs, broken links, and reconciliation to the general ledger. Clear labels, consistent formatting, and documented assumptions are essential so another analyst can review and maintain the model. Discuss pivot tables, Xcel OOKUP or index match, SumIfs, logical formulas, data validation, Power Query, charts, scenario tools, error checks, and model transparency. Question 16. How would you use Power BI or another reporting tool in FP&A? I would use Power BI to turn validated financial and operational data into a consistent management view. I would first define KPI ownership and source systems, then build measures for budget, actuals, forecast, and key drivers. Dashboards could provide executive summaries with drill downs by region, function, or project. I would control refresh timing, access, and definitions carefully. Visualization should accelerate insight, not hide data quality issues, so reconciliations and documented business rules remain important. Cover data governance, source integration, KPI definitions, interactive dashboards, drill downs, refresh controls, user needs, and using visualization to support decisions rather than replace analysis. Question 17. How do the income statement, balance sheet, and cash flow statement connect in FP&A? Net income from the income statement flows into retained earnings, while non-cash items such as depreciation are adjusted in operating cash flow. Capital expenditures reduce cash and increase property, plant, and equipment on the balance sheet. Depreciation then lowers that asset balance over time. Working capital movements also affect cash without necessarily changing earnings immediately. I would build the statements together so operational assumptions, financing needs, liquidity, and accounting results remain internally consistent. Explain earnings, working capital, depreciation, capital expenditures, debt, cash, retained earnings, and how an integrated model prevents inconsistent forecasts. Question 18. How would you forecast cash flow for a capital-intensive utility? I would begin with operating cash flow from projected earnings, non-cash expenses, and working capital movements. Then I would layer in capital expenditures by project and timing, debt issuance or repayment, interest, taxes, dividends, and other financing activity. For a utility, construction spending and regulatory collections can create important timing differences, so I would monitor monthly liquidity rather than only annual totals. I would also run downside cases for lower demand, higher commodities, storm costs, or delayed recovery. Discuss operating cash generation, capital spending, working capital, debt maturities, dividends, tax, regulatory collections, liquidity, timing, and downside scenarios. Question 19. What is regulatory accounting, and how can it affect FP&A analysis? Regulatory accounting can allow certain costs or benefits to be deferred as regulatory assets or liabilities when recovery or refund through future rates is probable and approved treatment exists. This affects the timing of expense recognition, cash recovery, and earnings. In FP&A, I would understand the underlying cost, regulatory order, amortization period, and remaining balance rather than treating the deferral as permanent relief. Close coordination with accounting and regulatory teams is essential because assumptions can change through rate proceedings. Mention deferrals, regulatory assets and liabilities, matching costs and recovery, approved treatment, amortization, rate cases, earnings timing, and the need to coordinate with accounting and regulatory teams. Question 20. How would you assess a proposed renewable energy investment? I would evaluate expected generation, capital cost, operating expense, interconnection requirements, tax incentives, contractor rate recovery, and the project's contribution to reliability and emissions goals. I would model production variability, curtailment, power prices, construction delays, financing costs, and changes in policy support. The recommendation should combine financial value with regulatory and strategic considerations. I would clearly show rate impacts, cash timing, downside exposure, and how the asset supports Xcel's broader transition plan. Cover strategic rationale, production assumptions, tax credits, capital cost, operating expense, interconnection, reliability, emissions, regulatory recovery, financing, and scenario risks. Question 21. How would you model the impact of inflation and interest rates on Xcel's plan? I would identify where inflation enters the plan, including wages, materials, maintenance, construction, and purchased services, then apply assumptions by category rather than one universal rate. Higher interest rates would affect debt costs, financing plans, project carrying costs, and investment returns. I would run sensitivities for both operating expense and capital spending, assess customer and regulatory implications, and update financing assumptions consistently. The analysis should show which pressures are recoverable, temporary, or likely to affect long-term affordability. Discuss labor and material inflation, borrowing costs, project economics, rate-based financing, customer affordability, sensitivity cases, hedging, and updating assumptions consistently across the model. Question 22. How would you handle an unexpected storm or wildfire-related cost event? I would first coordinate with operations, emergency response, accounting, and risk teams to establish the best estimate of restoration and related costs. I would separate capitalizable work from operating expense, identify insurance or regulatory recovery possibilities, and assess cash timing. I would update the forecast with a clearly documented assumption, create downside scenarios if the event is still developing, and escalate material impacts promptly. Accuracy matters, but so does speed, because leadership must balance restoration, liquidity, and customer needs. Mention immediate estimate validation, safety and operational coordination, cost classification, insurance or regulatory recovery, cash impact, forecast updates, scenario analysis, and transparent escalation. Question 23. How do you ensure accuracy and control in management reporting? I would reconcile reported actuals to the general ledger, validate source data, and use standardized definitions for every KPI. Forecast inputs should have named owners, deadlines, and documented assumptions, with version control preventing unauthorized changes. I would build automated checks for missing data, unusual movements, duplicate records, and totals that do not tie. A review by a second person is valuable for material outputs. These controls create confidence while still allowing FP&A to move quickly. Focus on reconciliations, source system integrity, standardized definitions, review controls, variance thresholds, version management, audit trails, segregation of duties, and documented assumptions. Question 24. How would you prioritize competing requests during budget season? I would rank requests by decision impact, deadline, regulatory or executive importance, and dependency on other work. I would clarify the required output and level of precision before starting, then create a visible task list with milestones. Reusable templates and early data requests would reduce bottlenecks. If priorities conflict, I would communicate trade-offs promptly and escalate with options rather than silently missing deadlines. I would protect quality for material forecasts while providing appropriately scoped preliminary analyses when speed is critical. Discuss urgency, materiality, decision impact, deadlines, dependencies, stakeholder communication, reusable templates, escalation, and protecting quality in high-risk deliverables. Question 25. Why do you want to work as an FP&A analyst at Xcel Energy? I am interested in Xcel because FP&A here combines rigorous analysis with decisions that affect essential service, reliability, affordability, and the clean energy transition. The company operates in a complex environment involving regulation, major capital programs, weather, commodities, and long-term infrastructure planning. My strengths in modeling, variance analysis, data quality, and communicating with non-finance partners fit that environment. I would be excited to learn the business deeply and help leaders allocate capital and manage performance responsibly. Be sure to connect analytical interest with Xcel's regulated utility role, capital investment, clean energy transition, reliability, stakeholder impact, learning opportunities, and your relevant skills. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.